the Gamestop trading stop, or how I learned to stop worrying and love the short squeeze. So what's a short squeeze? And I don't mean hugging a dwarf or a hobbit. Greetings Earthlings, I'm Dr. Will and welcome to Dr. Will Presents. If you'd like more content like this, then subscribe to the channel and hit the bell below so that you can be notified when there's new content. In the novel Catch-22, Yossarian, who's the main character, said, "They're trying to kill me." Clevenger, the guy he's talking to, says, "Nobody's trying to kill you." And Yossarian says, "Then why are they shooting at me?" Clevenger answers, "They're shooting at everybody. They're trying to kill everyone." And what difference does that make? So the system is rigged. Not against you, but against everybody. Okay, most casual investors are not familiar with the term short sale. It's basically just flipping the buy low, sell high kind of paradigm on its head, where you sell high in expectation of the stock price or the price of whatever going down, and then you buy low to cover the what you sold earlier. Buying a stock is known as being long in the stock, so selling it when you don't have it yet is called a short sale, and it's also known as shorting the stock. So how can you sell something before you own it? Well, in most modern markets, you can sell something by borrowing it to sell it, and in order to borrow it to sell it, you have to have a pool, not a puddle, but a pool of assets or capital that you can pledge to show that you have the ability, the wherewithal, to buy it back later on. And what happens is if the price, which you're expecting to go down, goes up instead, from time to time you'll get a call saying, "We need more assets to cover your assets," and that's called a margin call. So if the price goes up, remember you're expecting it to go down, you get a margin call to put more assets in the pool. By the way, I was once told by somebody wise in the ways of Wall Street, never meet a margin call. You lost, take your beating, get out, you chose poorly. So a short squeeze is the result of somebody cornering a market. Cornering a market means you gain control of a stock, a commodity, or a security so that you can manipulate the price. A very famous cornering occurred in 1862. Cornelius or Commodore Vanderbilt cornered the market on the Harlem Railroad, anticipating its strategic value during the course of a bear market. The move not only gained him a small fortune, but it also got him control of both of the rail lines into Manhattan. The investors were shorting the stock on this Harlem Railroad, and these weren't just a normal kind of group of investors. They included members of the New York City Council and executives of the company itself. The idea was they were going to sell the stock down, revoke its license so the value of the stock would go down to like nothing, and then buy it back at that nothing, and then get control of it. Well, Vanderbilt knew what was going on, so he kept buying and buying and buying and buying. So he kept buying the stock, and they kept selling the stock. Pretty soon he knew that they had sold more of the stock than was outstanding, so he had them. So in his charity, he offered to let the city council members off with small losses as long as they reinstated the license to operate the railroad, which they did. So the big loser here was this Daniel Drew, was one of the investors and a competitor of Vanderbilt's. So in other words, here's how this works. Let's say I know you're selling short Acme widgets, and I buy and buy and buy and buy. So pretty soon I know that you've sold me 101% of the Acme widget stock. Well, you can deliver 100% of the Acme widget stock and you still owe me 1%. Where are you going to go to get that 1% if you've delivered me the 100%? Well, you'd have to come to me, wouldn't you? And what could I charge you for that stock? Well, any price I liked because I'm the only person, I've cornered the market. I'm the only person that has the stock to sell to you to deliver to me. And that's how it works. That's a short squeeze, and it can result in bankruptcy, demoralization, and shame. Enter the hedge funds. A hedge fund is basically a mutual fund that is controlled by a fund manager, and it has a bunch of participating limited partners. The fund manager is usually called the general partner, and the investors are the limited partners in this fund, and they pool their money together into this asset pool. So they're like mutual funds, but they're not regulated like mutual funds. They are for the well-heeled. So they're mutual funds, but they have a wide latitude to speculate or invest in risky kind of ventures. They invest in high-risk things with hopes of big returns. They're market neutral. That is, they expect to be making money both when the market is going up and when the market is going down. So when the market's going up, you're buying low and selling high. And when the market's going down, and this is a market in either the general overall market or a market in a single stock. So if you're going to make money on a stock going down, that means you're doing what? You're doing the short sales, right? And this is what happened. A group of hedge funds reasoned that Gamestop, like Blockbuster, was a bricks and mortar outfit whose time was over, whose time was past. And so they started short selling the stock in GameStop. A group of day traders on Reddit, in the group Wall Street Bets, had different ideas. They had looked at the fundamentals of GameStop and thought that the GameStop was changing its business model and had a good chance to succeed. So they saw this short selling going on, and so they started buying. And so it's the classic kind of they bought and bought and bought, and the hedge funds sold and sold and sold. Ultimately, the hedge funds sold, I read somewhere, 140% of the outstanding stock in GameStop. So the forum members had gotten together and had continued to buy the stock. The price of the stock went up 1,500% over the course of a month. Well, here's where it gets kind of dicey. Their trading app, Robinhood, stopped trading in GameStop, and other online investors or online brokerages stopped trading as well. This is where you have a big public outcry about the people changing the rules in the middle of the game and all that kind of thing. Tell it to the Hunt brothers, and I'll talk more about the Hunt brothers at some point if there's an interest in their effort to corner the silver market back in the 70s or 80s. So there's been a huge public outcry about this intervention, apparently on behalf of the hedge funds. So here's the long and the short of the GameStop situation. Short sellers are reported to have lost $19 billion in GameStop stock in 2021. Reddit subgroup members have sent the stock price soaring 1,500%. GameStop's rise has hammered hedge funds, with 140% of the GameStop stock having been sold short. It didn't take a lot of effort to corner the market in GameStop. So there's a couple lessons to draw from this. First, if you're going to take on rich, ruthless people who manage tons of money in a highly competitive industry that rewards and reinforces cutthroat competition, then do not be surprised when and if they bring the noise. Second, the system is not rigged against you. It's rigged against everybody. And what difference does that make? A conversation is always more interesting than a monologue, so join in, send me a note, or put a comment below, and I will get back to you. That's it for me, for you for now. Thanks for joining me. Hope you have a great week. Be careful out there. Be careful with your money out there. I'll be seeing you. Bye. That's a wrap.